Medical Properties Trust, one of the leading healthcare REITs in the market, has reported favorable results in 2022. Despite a slightly challenging economic environment, the company managed to achieve impressive financial performance, with its revenue showing no significant change compared to the previous year, while net income surged by an impressive 37.7% year-over-year. However, despite these positive financial indicators, the stock price has experienced a decline of around 55% since then. This is because the finances of its key tenants have worsened due to the pandemic. As tenants restructure and interest rates rise, drives a significant risk of a dividend cut and potential stock price decline. Today we'll take a three-step approach to thoroughly evaluate and determine the fair value of Medical Properties Trust and as an investment opportunity. Step 1. Margin of safety. In this step, we'll assess Medical Properties Trust key metrics and ratios to determine if we should be more or less cautious when determining its fair value. We will delve into the company's financial statements and assess critical metrics and ratios. In step 3, we will use a combination of valuation techniques such as funds from operations and discount dividend to gain insight into the value of the business. By applying these metrics, we'll understand whether the stock is overvalued or undervalued in the current market. In conclusion, the three-step approach will allow us to thoroughly evaluate Medical Properties Trust's financial health and performance. By combining the findings, we will determine whether the stock is undervalued or overvalued in the current market. To determine the final value of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never be below 0%. The margin of safety will either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be using are the margin and the EBIT growth. The EBIT has gone up over the years, going from $97 million in 2013 to over $700 million in 2022. The average EBIT growth during this period was 29%, which is in the bright green part of our scale, indicating a 10% deduction from margin of safety. The margin has also gone up over the years, going from 39% in 2013 to 45% in 2022, seeing a big spike in 2018 where the margin was 65%. Margin growth during this period has been 4.5% on average, which is in the bright green part of our scale once again, indicating in this case a 5% deduction from a margin of safety. The next two metrics that we'll be using are the dividend growth and the debt to EBITDA. The dividends have gone up over the years, going from 84 cents a share in 2015 to $1.16 a share in 2023. The dividend growth during this period was 4% on average, which is in the orange part of our scale, meaning no change in the margin of safety. To calculate the debt to EBITDA of a company, we take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for MPW, this is just over 7.5 years, in this case a 755% debt to EBITDA ratio, which is far into the red in our scale, which is a 5% increase in the margin of safety on this metric. The final two metrics that we'll be using are the occupancy rate and the rent reversion rate. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. For MPW, 99% of their property is occupied, which is in the bright green part of our scale, meaning a 5% deduction from margin of safety. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for a property. Looking at the graph in the top right, we can see that the rent reversion rate went down by 5%, indicating that they made less rental money out of their property that they gained over the years. This indicates a 5% increase in the margin of safety on this metric. Looking alright so far for MPW, let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to funds from operations mean reversion. The price to FFO mean reversion is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be under or overvalued and is expected to revert to its average over time. In this case, we've imported the share price and the FFO per share of the past 4 years, and on average it has been sitting at a price to FFO ratio of 13.03. The trailing 12-month FFO per share is significantly larger than it has been in the past 4 years, indicating that it's currently undervalued on this metric. And this gives us a price per share of $29.17 out of this model, which is almost a 179% upside from the current price. That's pretty incredible. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of MPW going from 2018 to 2022. The average growth rate in the dividends during this period has almost been 3.8%, and I'm projecting no growth whatsoever in all of their future dividends, seeing as they have some problems with their tenants currently. I will be using a discount rate of 10% in this valuation, giving us a dividend discount model price per share of $11.60, which is almost an 11% upside from the current price. The next model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of the cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to AFFO, we can assess the relative value of the REIT compared to its peers. In this case, I've imported 3 similar companies to MPW and their price to AFFO. And on average, in the industry, the average price to AFFO is sitting at 12.09, while the price to AFFO for MPW is sitting at 7.66, meaning that it's significantly undervalued on this metric, giving us a price per share of $16.51, which is almost a 58% upside from the current price. And the last valuation model that we'll be using is the net asset value. The net asset value is a straightforward valuation that estimates the value of a REIT based on the fair market value of its underlying assets minus its liabilities. The value of a REIT's assets is typically determined by appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. The trailing 12-month net operating income for MPW has been sitting at $644 million, and I'm expecting it to decline by 5% in the next year, giving us a forward year net operating income of $612 million. The capitalization rate I'm expecting to be 3.5%, giving us a value of the underlying assets of almost $17.5 billion. Deducting the debt from this, we get a net asset value of just over $7 billion, and dividing this by the amount of shares outstanding, we get a net asset value per share of $11.81, which is almost a 13% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you could check in the description for my Patreon link. Anyways, getting this self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported price to FFO, discounted dividend, AFFO multiple, and the net asset value price per share, giving us an average of $17.27. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 10% for the EBIT growth, 5% for the margin growth, and 5% for the occupancy rate, and adding 5% for the debt to EBITDA and rent reversion rate, giving us a margin of safety of 15%. Applying this margin of safety, we get a fair value of $15.02, and with the current price of $10.46, we get an upside of 43.61%, indicating that's currently a buy. But of course, be cautious when investing in such a risk-heavy stock. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.